So look at the life cycle of a company share from discovery to production. We start off with exploration and discovery, drill results come in, there's a bit of activity. Further results define some resources, and that's when the share price kicks up. Institutional investors often get involved at this point. Stage 3, in feasibility study, investors start getting a bit jittery. They don't know whether the feasibility study will actually progress the project to actually become an operation. Share price drops off. A decision to progress to production is granted, but the share price flatlines a bit because they have to apply for permits and finance applications. They don't know whether they're going to get them. Permits for finance get approved. The share price generally kicks up again after this point. We bring the mine into production, and the share price should carry on further from that. Now that above discussion is very simple, and the stock price is also influenced by general market risk and commodity price risk. And you can't really do this for a company that has multiple operations because the share price is affected by all the different ones. But if we just look at one company with one operation, one discovery, we'll look at Andy Well again. From their float of 20 cents, within a month they drilled Andy Well and the share price has tripled. A little bit of profit taking goes on, and then they do more drilling and they discover their high grade Wilbur lode. And so in the space of about 7 months, they've gone from 26 to $1.51. It's a nice healthy increase. A share placement, the share price drops off a bit. The maiden resource is announced, the share price goes down further, so maybe the resource that they announced didn't quite meet the investors' expectations. Another discovery, more extensions to Wilbur, and this is coupled with some of the highest gold prices we've seen in the last 20 years, so it's up at 1900 at the moment during that time in 2011. Share price drops off as we're doing scoping and feasibility studies, pops up again as construction commences, falls down again, and then comes up again as production commences. Once again goes up when there's a discovery, the high-grade Kirsty lode is discovered. And as in 2014, a lot of gold company share price started coming off with the falling gold price, and an asset impairment along the way made share price go down further there. So we've looked at mining an ounce of gold and how much it costs, but now we're going to look at the whole production of an ounce. So this is putting it through the mill and delivering it to its buyer. So as you can see on this graph, there's two costs there. We've got an all-in sustaining cost, and we've got something called a C1 cash cost. So why have two reporting costs, and what's the difference between the two? Now we'll look at that in a minute, but the idea on this graph is that this is ordered by the all-in sustaining costs. So the left-hand side of the graph is where you want to be. Cadia Valley, you see the lowest grade, but also the lowest cost producer. That grey bar is essentially the byproduct credits that you're getting from the copper, and quite nicely on the graph there is around about 950 is what we had in our calculation earlier. Some companies only report a cash cost, some only report an all-in sustaining cost. And I've just slotted CNMC's cost structure in there just for comparison. It's sitting very well on the left-hand side of the graph. It's been converted into Australian dollars as well. So the difference between a cash cost and an all-in sustaining cost. A cash cost is the cost of production at the mine. It's how much it costs to produce an ounce at the mine. So this involves mining costs, earth moving, drill and blast, processing costs, things like electricity, on-site salaries, things like fuels, tails, grease, and water. Now this is what the price doesn't include. So there's a lot of things in there. The all-in sustaining cost includes the cash cost plus all those other expenses. So the head office costs, G&A's general administration practically means head office costs. So that's things like office rent, parking, staff salaries. The money's got to come from somewhere. It's got to be accounted for somewhere. Interest expenses, off-site costs, taxes, any royalties that need to be paid. It also includes exploration expenses. And it also includes sustaining capital. Now these two costs do not come from audited numbers. And this is a press release from CNMC in November last year, and this is talking about how they're improving their continuous all-in costs, and it really is an excellent way of reporting. It's very transparent, it's very clear, and it explains everything. Each of those three footnotes there relating to the table above clearly explains where the costs are coming from and why they might differ in the future as well. It's very good reporting.
When a company announces, as you said, different line items which then don't add up, how much do we as investors need to be aware of the shenanigans that some of these mining companies might throw at us?
Yeah, I guess the shenanigans that they throw at you, they're not done intentionally. A lot of people look at these figures and you can interpret them a number of different ways. There's no clear accounting practice for those costs, the cash costs on site and the the all-in sustaining costs. I mean, they report two costs because it's handy to know what your on-site costs are. If you're a company that owns a number of different operations, it's rather than just reporting one cost, if you break it down by operation, you can see which operations are quite lean and mean and operating. The all-in sustaining cost might still be very high, but their cash costs might be very low. So they've actually got their house in order on site, and they're producing gold very cheaply at face value. But when you put all the other sustaining costs into it, it makes it look like a much higher cost. So it is good that they do show two costs. Some of them still aren't that transparent. There are still some companies that don't report royalties, third-party royalties, that is. There's government royalties, which I touched on. There's a lot of companies that have third-party royalties. And some companies will give a price pre-royalty and post-royalty, and sometimes you've really got to go in and look for some of those royalties in there.
Royalties, red flags, I suppose. Are there any other red flags that we should look for?
Yeah, royalties don't necessarily have to be a red flag either. I mean, there's the state ones that you can't get around as well, and the third-party ones. Sometimes it stops companies doing it, and other times it won't. If the deposit's good enough, it will be mined, and you pay the royalty. So I'm not saying this is bad reporting, but this is where figures can get confused sometimes. This is a real-world example. We've just renamed it Company Y. Let's go through what we already know. So they produced 77,000 ounces of gold. We've got their C1 cost. We've also got their all-in sustaining cost. The big difference between the two, one's double. So we can work out what the operating margins are between the two. We know what the average price is that they sold it for. So therefore, we can calculate a profit on the cash cost and also a profit on the all-in sustaining costs. And there's a 40 million change, but we've explained that because we know that one only includes on-site costs. We confuse ourselves further when we look at the audited figures from the company balance sheet. Now it's telling us we've got a profit or loss of nearly 26 million. So that's 9-10 down on the all-in sustaining cost profit. So what's going on there? And then we further confuse ourselves by adding up the gold, times in the gold that they have by the price, and coming up with a very different figure to the revenue of our operations. There's about 5.5 million difference there. Now this can be explained because the top figure of gold ounce produced is gold produced. Now the revenue has come from gold actually sold. So there's obviously a difference between the gold they produced during the year and the gold that actually made its way to sale. But the cost and production of sales would have been included in that gold produced. So perhaps a better way of illustrating the actual realistic cost there would maybe be to divide the ounces produced by the actual costs. And here we come up with something that's about $50 more expensive than the all-in sustaining cost. If we look at Company Y amongst a couple of its peers, Company X and Company Z, and while we've got gold that hasn't been sold in the example of Company Y, for the other two, they've obviously had a situation where they haven't sold gold from the previous period, and then it's been accounted for in the next period. Because when we add up the gold ounces produced and see the revenue that they've got, it's the equation's out the other way. Something that's also included in the costs is government royalties. They're quite straightforward in WA, Victoria, South Australia, and New South Wales. However, in Queensland, Tasmania, and Northern Territory, they come a bit more complicated to work out. There's a lot of individual agreements and various allowable deductions that you can claim along the way. So essentially, depleting the asset, gold miners are in a constant battle to renew their reserves. Since gold is finite and difficult to find, as it is mined, it reduces the overall mining life of the company unless the ounces that are being mined are replenished. So how do we do this? We can find more gold. Sounds simple. Or we can buy another company's gold. Or a rising gold price, which is something the company doesn't have a control over, can also convert known resources into economical reserves. In addition to the above, fluctuations in foreign exchange rates aid that third point as well as affecting the profitability of the mine. So here we look at about the last 6-7 months of the Australian gold price and the American gold price. If we take the highest point of the Australian gold price there, about 1650, and look at the difference to the American dollar. At the start of the graph, the American dollar is exactly the same. However, the price of gold in Australian dollars has benefited from falling away against the US dollar. Now, if we look at a few scenarios of that with foreign exchange, a lot of commentators talk about $2,000 gold, and they're talking about $2,000 gold in US terms. In 2011, it looked like we might get there. but it certainly doesn't look realistic at the moment. But how about $2,000 gold in Australian dollars? And I must emphasise here, these really are just scenarios. If we look at the blue line there, this is assuming an increase in the US gold price from 1,200 to 1,600. And the exchange rate doesn't even have to move. It can stay at about 79 cents. And we're on the way to $2,000 Australian gold. The red line assumes a decrease in the foreign exchange from 79 cents to 63 cents and keeping the gold price steady at 1,200. And that's pretty much what it looks like it's doing at the moment, remaining around that 1,200 mark. And we're well on the way to $2,000 gold again. Put the two together, and as you can see, that grey line skyrockets. And we get a crossover of about $1,400 US gold with an exchange rate of 72 cents, but also give us $2,000 gold in Australian dollars. Those are only just scenarios, and the benefits of those scenarios would only apply to companies that are selling their gold in Australian dollars.
Jeff, here's an easy one for you. Where's the price of gold going to be in 12 months from now?
Thank you for that bullet. Yeah, look, it's interesting. I suppose I'm not a gold bull or bear. I look at it more on a supply, demand, and a cost basis. You know, I look at the current price around 1170, and I think Alan's slides sort of indicated a bit there. There were companies X, Y, and Z, and I have a faint suspicion X, Y, and Z were all Australian companies. And if you looked at those costs, those all-in costs, they were around $1,100, $1,000.
So there's not a lot in it, in other words.
That's right. So you know, there's a level, and I think that level is around the $1,100, $1,000 per ounce US dollar, that a lot of companies are starting to feel pain that are in production. So once that production starts to come off, you know, you're going to see a floor in the gold price, and you know, my view is that you're probably pretty close to that floor. Doesn't mean it couldn't fall to say 800 for a month and then come back, but certainly if you look in Australia, Canada, South Africa, there's probably a 20-30% of producers that are in that range, and once that production starts falling off, you'll see a floor in the gold price. You know, I mean, there's inflation, there's a variety of other aspects, but you know, the old adage of, you know, US dollar going up, gold price going down, inflation, you know, I think it's a very complex, there's a lot of different things. There's not just, you know, a one-to-one correlation all the time. You know, you've seen a very strong US economy, a lot of money going from emerging markets into US equities. You know, people are now saying the US equity market's getting expensive. You know, I don't know. I think it's about diversifying that risk and having exposure to a variety of asset classes, and gold is one of those asset classes, and you can get exposure, you know, via a junior company, a mid-tier or a major, or from ETFs. And it's about, you know, I think spreading that risk probably across a couple of those gold exposures.
So your short answer to my question is don't know, but also don't
Correct.
really care by the sounds of things, right? You're saying it's the supply and demand. And I suppose on the demand side, we've known for some time it's about, particularly when the Indians and the Chinese buy lots of gold, I suppose for jewelry. Electronics obviously also consumes a lot of gold. And the central banks have been buying, obviously, in recent years after selling a lot about 10 or 15 years ago. But when it comes to the cash costs, which is something that obviously the companies can control, as Alan said, they can't control the price. How much flexibility do they have? In other words, as shareholders, how much opportunity do you have to raise your hand at the AGM and say, CEO, your costs are too high? I mean, do they really have the ability to cut some of these all-in costs?
Oh, look, I think they do. You know, G&A's a big one.
General and administrative.
Costs, yeah. I mean, look, we're a private equity firm, right? And when we fund projects, we like to see a management team that's got their own money in the company, and that when the price goes down and times are getting tough, that, you know, the management reacts to that. You know, they reduce their salaries. You know, they're not flying business class globally, attending, you know, a conference every second week.
Like you guys.
Yeah, like the private equity guys do, yeah. So, you know, they're things to look for, and they're questions you can ask the companies directly. And again, you can compare salaries, you know, by looking at annual reports. You know, if someone's paying themselves $500,000 and it's a development stage company, I'd sort of be sitting there saying that's probably not really appropriate at this point in time. You know, look at the majors and the mid-tiers and the juniors and look at their annual reports and look at, you know, expenses, head office expenses. If you're a single asset company, you know, you should be very lean, you know, you should have a very modest head office. You know, the bigger the company gets, the more, you know, administrative costs you get. It's just the reality, but you can cut those back. And you know, look at Rio Tinto and these groups now, they're doing that, right? They're shedding staff, they're reacting probably, you know, a bit behind the eight ball, but they are reacting.
Because to some extent, again, what we hear here in Singapore is that Australians who work in the mines in some capacity are paid more than Manhattan lawyers, you know, including the people who drive those big trucks. By the way, did you know that those cabins of those big trucks are air conditioned, and the servos, the power steering on those trucks is so strong? Tell me if I'm wrong, but you can actually use one finger to turn the steering wheel. So as a result, you get a lot of housewives applying to drive those trucks. And they get paid $120,000, $150,000 a year. Is that still true? And if so, again, how much chance does the CEO have to say, we're going to cut the truck driver salaries?
Yeah, look, I suppose that the challenge is when commodity prices are high and there is capital available to companies. You tend to have these boom markets and it's hard to get skilled people. That's why companies went out and looked for female truck drivers, because they couldn't find enough people to drive the trucks. And female truck drivers are actually far superior to males because they're not as aggressive and they don't bang the trucks up as much.
How are they at parking those trucks though?
Well, you've got a reversing light and it's not that, it's probably easier than parking here in Singapore, to be quite honest. So what you're seeing now is, you know, commodity prices are down, times are tougher, so, you know, people's salaries are coming down. There are actually, you know, more people available to do this work because, you know, people are getting laid off in these more challenging times. But there's still an onus on management and the board to look at their cost structure and keep that under control. And I think, you know, sadly, the mining industry wasn't very good at that in the boom times.
Nobody is good at it during the boom times.
No, that's right. And that's where you can see a good company when you look at it, you know, how they incentivise themselves, how they manage their costs. And you can see someone whose incentives come from more share price performance than receiving a big cash salary.
Jeff, being in the business that you're in, obviously you work very much with people like Alan, people who are reputable and know what they're doing. But I suspect from time to time you also come across people where you think, yep, they're not quite there. There's something missing. Can you share that expertise with us so that when we're considering investing in gold mining companies, that we also kind of know when something doesn't sound right?
Yeah, it's a good question, and I suppose there's no silver bullet answer. You know, again, it comes back, you know, as I suppose Alan's highlighted, the quality of the asset. So, you know, looking at the cost-based location, are you in a mining jurisdiction? You know, is there a history of mining? I.e., should there actually be a mine here? You know, are there other mines? You know, there is a deposit. You can see the company's done the right thing by using consultants, you know, legitimate consultants who are well known to prove there's an ore body. But then you've got to look at that management team, and, you know, we typically look for people who've been in mining, you know, most of their careers.
And gold mining, presumably, not just, I've done iron ore and coal in the past.
Well, not necessarily. I mean, some of those skills are transferable. You know, I suppose it's looking at that person, understand their motivations. If they were, you know, if they were in IT and all of a sudden they came to mining, you'd want to understand clearly why they're doing that. And you'd want them to feel comfortable that they're doing it for the right reasons. You know, I think as long as someone's been in mining most of their career, you can transfer those skills across. You need to hone them, but you know, bulks, as Alan sort of pointed out, bulks are very different from gold and copper.
Except the competent person, according to the JORC code, must still have gold mining experience, does he or she not?
Yeah, well, they need to have experience in that commodity
In
and those
gold, in this case.
mineralised systems, which is important.
In 5 years.